Hey there, hello, Sindre here. In this lecture we're going to learn how to draw the capital market line, which looks a little bit like this. In order to draw the capital market line, or CML for short, we're going to need two assets. And we're going to use two fictional assets which have the very creative names of asset A and asset B. And for both of these two assets, we need to know two things. We need to know their average returns, and we need to know their standard deviations. And it must be the case for the two assets that we choose that one asset is not dominating the other one. And by that I mean, for instance, if asset A has a greater average return than asset B, then asset A must also have a greater standard deviation than asset B. Because if that was not the case, if asset A, for instance, had both a greater average return than B and a lower standard deviation than B, then A would be better than B in all aspects. There would not be any reason to invest in B whatsoever, because you could get a higher average return at a lower risk from asset A. We are going to start off by drawing a diagram with two dimensions. On the x-axis, we're going to have the standard deviation of the portfolio's return. And on the y-axis, we're going to have the expected return of the portfolio. We can start by adding two data points to the diagram, which represents asset A and asset B. Now, with these two assets, we can create certain portfolios. We could, for instance, create a portfolio which have 50% of asset A and 50% of asset B. And in order to know what the portfolio return and portfolio standard deviation will be, we can use these two equations to calculate it. Now, there are various other portfolios that we could create. We could, for instance, have a portfolio consisting of 25% of asset A and 75% of asset B. Or we can do the exact opposite and have a portfolio consisting of 75% of asset A and 25% of asset B. So what we want to do is to draw a curve which shows the portfolio return and portfolio standard deviation of all possible portfolios. And this curve is called the feasible set, or sometimes also the opportunity set. There are two portfolios on the feasible set that are of particular interest. That is the minimum variance portfolio, MVP for short, and the tangent portfolio. Let us start with the former. The MVP is simply the portfolio that has the lowest standard deviation, and finding it is quite trivial. If we only look at the portfolios with a portfolio return greater or equal to that of the MVP, then we get what is called the efficient frontier. So if you start with the feasible set and cut away all portfolios with an expected return less than that of the MVP, we end up with the efficient frontier. There are no reason whatsoever to ever invest in a portfolio that is not on the efficient frontier. So if you are in the red part of the curve, there will always exist a portfolio which has the same risk but a greater expected return. So you will always want to be on the efficient frontier. To find the tangent portfolio, we need to first calculate the Sharpe ratio for every possible portfolio on the feasible or opportunity set. The Sharpe ratio is given by a simple equation. Is the return on the portfolio minus the risk-free divided by the standard deviation of the portfolio. Once we have drawn this Sharpe ratio curve, we need to figure out where the maximum Sharpe ratio is. And once we know where the maximum Sharpe ratio is, we will also know where the tangent portfolio is located on the efficient frontier. The final step is to draw the capital market line. So if we, for instance, assume a risk-free rate of 8%, all we need to do is to draw a straight line going from the risk-free and through the tangent portfolio. And that will be the capital market line. So the equation or formula for the CML is going to be equal to the risk-free plus a beta coefficient multiplied by the standard deviation. And the beta coefficient is going to be equal to the portfolio return of the tangent portfolio minus the risk-free divided by the portfolio standard deviation of the tangent portfolio. And that is how you create the capital market line, at least theoretically. So let's jump over to Excel and look at an example. Here we are in Excel, and as you can see, I already have the data. Now this is not the real data, I just simulated it using a Monte Carlo simulation. And did that with Visual Basic Applications, or VBA, which is the programming language of Excel. So if you click Alt F11, then you can open up the VBA editor. And here you can see the code that I have written. And I won't go into details on how this script works in this video at least. So when you open up VBA, you can click Alt IM to open up a new module, because it's going to be gray when you do it for the first time in a new spreadsheet. And then you can just type in this code. So our first order of business is going to be to calculate the average return. So I'm going to type in here equal to the average and here in cell A2 I can click Control Shift and then arrow key down in order to select all of the data. I add the end parentheses and I click Enter. So our return is almost 15% for asset A. We can copy paste this to asset B to get that it has average return of 10%. Next we need to figure out the variance. So we type in equals var, and there are two different variance equations we can use here. We can use var.p or var.s. So one is for population and the other one is for sample. And we are going to use sample. So we do the same thing. We go to column A2, or to cell A2 I mean. Click Control Shift and then we tap the arrow key down. Add end parentheses and Enter. And we can Control C, Control V. So here we have the return and the variance. We also need to figure out the correlation between these two assets. And I suppose I forgot to mention that in the theory part of this lecture. So we write correl, and we select asset A, and we select asset B. There we go. Now we have everything that we need. So first off, next we need to figure out the weights. It does not matter what we use as weights. Obviously the weights needs to sum up to 100%. But if you take 50-50, 0-100, 100-0, 25-75, it doesn't matter. Because we're gonna loop through and try every possible combination. So in weight 1, let's for the time being take 0.6, 60%. Now weight 2 will then be 40%, but it's really important that we do not hard code, that we don't type in 0.40. What we instead are going to do, we're going to type equals 1 minus weight 1. If you don't do that, if you hard code, then this is not going to work. So what we do next now is to figure out the portfolio return. and that is going to be equal to weight 1, so that's the weight for asset A, multiply by its average return, and then I'm going to add weight 2 multiplied by the average return of asset B. Very good. So I can show the equation here so you can see what's going on. For portfolio standard deviation, that's going to be equal to square root, but let's just forget that for the time being. So it's going to be weight 1 squared multiplied by the variance of asset A plus weight 2 squared multiplied by the variance of asset B plus 2 times weight 1 times weight 2 multiplied by the covariance between A and B. Now I don't have the covariance here, but I do have the correlation and the variances. So what I can do, instead of taking covariance, I can take correlation multiplied by the square root of variance of asset A multiplied by the square root of the variance of asset B. So covariance is equal to correlation multiplied by the two standard deviations. And this will be the portfolio variance. But I want the standard deviation, so we're going to wrap all of this in another square root. Just like that. And there we go. Now, we have calculated the portfolio return and the portfolio standard deviation for one single portfolio, but we need to know all possible portfolios. So what I'm going to do here, I'm going to use something called data table in order to automatically calculate these two statistics for various different weights. So we need to decide on the granularity here, so let's say maybe a quarter of a percent. So first 0% of asset A, and then we're going to take 0.0025. We can make this in percentage. So the higher the granularity, the smaller the increments, the more smooth and nice the curve, the frontier is going to be. Right now I decided on a quarter percent, but we can go even lower. So if I now click Alt F3 and type in age 402, I believe it's going to be, click Enter, put in a placeholder value such as asterisk, and click Control arrow key up, and then I click Shift Control, hold these two, and then tap the arrow key down, click F2 and Control Enter. Now I will have the different weights from 0% all the way to 100%. And you can format this a little bit. We don't need more than 2 decimals. And I made a small mistake here. We need one free row up here. So I'm just going to move all of this one down with Control X, Control V. Now here in cell I2, I'm going to write equal the portfolio standard deviation that we calculated earlier. So I'm going to click Enter. And then the same, we need the return that we calculated earlier. There we go. And now I'm going to use the data table. So we start up here in the empty cell in H2. Hold down Shift and go arrow key to the right, arrow key to the right. And then while still holding Shift, we click the Control button and then tap the arrow key down twice. Then we go to data, which is up here. And then we go to what if analysis, and we're going to choose the data table. We then get this pop-up window. The first input we're going to leave empty, and we're going to use the second one instead. And there we're going to select weight 1, which we temporarily put to an arbitrary number such as 0.6. And we're going to click enter. And it will now generate all the data points that we need. So basically what happened here is that for each row, it's going to copy paste this weight over there. And then these two numbers will be updated, which are referenced over here. So these two will be copy pasted down. So for every single weight, we recalculate the new portfolio return and the new portfolio standard deviation. So now if we select these two, and we go to insert, and we go to scatter, then we get the opportunity set or the feasible set. So already we have done quite a lot. We can figure out what the minimum or where the MVP is. So the minimum portfolio standard deviation, we can type in equals min. So what is the lowest standard deviation going to be? And we can figure out what portfolio that is by using a combination of index and match. So I want to know at what weight can we find this minimum portfolio standard deviation. And remember to choose exact match, otherwise it won't work. So at the weight of 16.5% of asset A is where you're going to find the minimum variance portfolio. So you can scroll down here and see if that is the case. So at 16.5, that was over here. We can color that in yellow, for instance. It seems that we do not have enough decimals in order to know for sure which one is the smallest. Let's add some extra ones. So as we can see here, if you go one up, then the standard deviation of the portfolio becomes a little bigger. And the same also if we go downward. So we found the MVP. So we can do some formatting here, add a point here to denote the MVP, and we can change this lower part here to have a different color. But I'm not going to show that in the video. Our next step is to calculate the Sharpe ratio. And for that we need a risk-free. In the example that I'm following, we have a risk-free of 8%, which might seem a bit unrealistic, but it is what it is. So 8%. The Sharpe ratio is going to be equal to the return minus the risk-free. And it's important to lock this this number. There we go. You can do that with F4. If you're on a laptop, then you might have to click F and F4 because the F lock is engaged. And then we're going to divide by the standard deviation. And that is essentially it. That is the Sharpe ratio. I can go down here and put a placeholder and autocomplete. There we go. Now we have the Sharpe ratio for all of the portfolios that we have generated. So what is the highest Sharpe ratio? Well, that is going to be, we use the maximum function to figure it out. The highest Sharpe ratio is 0.3491. Well, at what weight do we find, or what portfolio is that? We can reuse the function we made up here. So I'm gonna just copy paste it, and then we can modify it. There we go. So at 0.38 or 38% and a quarter. So let's see if that is the case. So if we go down to, let's see, 38% and a quarter. So that would be over here. And is that the case? Well, yeah, again, we have a bit too few decimals to know for sure. So let's remedy that and check again. And it seems to be the case, but I still have too few decimals. Okay, let's add 2 more and see if that helps. Let's see. So here's 12. Here's 13. Yes, so as you can see, this is the highest Sharpe ratio that we can get. And that is at 38.25. But what is the return at this portfolio? Let's figure out, again, using index match. So we are looking for the, what are we looking for? We are looking for now the return, which was 11%, 11.88. Is that correct? Let's check. That is correct. And we can also figure out the standard deviation. There it is. So very good. Next, or finally, we're going to calculate the capital market line. For that, we need the slope. And that's just going to be the change in y, in return, divided by the change in x, which is standard deviation. So that's going to be equal to the return of the tangent portfolio, which we identified right here. I'm going to subtract the return of the risk-free, divided by standard deviation at the tangent portfolio, minus the standard deviation of the risk-free, which is, well, 0. So this is going to be the slope. And now we can calculate the capital market line. That is equal to the risk-free. We need to lock it with F4 or FNF4, plus the beta coefficient. And the lights turned off here in the office. Okay, this is actually another day. Run into some issues. So let's see where we were to finish this off. I noticed that I made a small mistake with the standard deviation. I just copy-pasted, down the formula. So it should be like this. I actually accidentally had it like this, so they became identical. But of course, we are supposed to be looking up the standard deviation. So a small mistake previously. But our final step here now is to calculate the capital market line. So over here, let's see, we can add in another column, which is going to be the standard deviation, like that. And let's see, our opportunity set doesn't go further than 25%, so let's say that we take 26%. Something like that. Let's take 26%. Gonna copy this over here, and then the capital market line is going to be pretty simple. It is going to be equal to the risk-free, which is over there, and we need to lock it with F4, and then we're going to add on the beta coefficient or the slope, which we already calculated over here. Lock it, and then multiply it with the standard deviation. And that is essentially it. We can auto-complete it. There we go. And we can finally add it to our diagram. So select data, add, x values are over here, and the y values, let's see, I got that wrong, it seems. No, oh, I did not get it wrong. There we go. And here we have it, the capital market line. So in theory, it should only tangent the opportunity set. It might not in our Excel spreadsheet because if we don't have sufficient granularity. So maybe we should increment here only by 0.10% or 0.01%. So, but this is essentially how you make the capital market line. So it was not that difficult, as you can see. If you're gonna do this on your own, then you need to simulate the data. You might get slightly different realizations. So what you can do is just to take in the returns and variance and correlation I have there. Here's the equations for the portfolio return and portfolio standard deviation. And I just use index match and the minimum maximum to figure out the different values. So here are all the equations, and that's just 8%. So that's it. That's how we do it.